Everyone knows that investing comes with risk. You could lose money in the stock market, or in real estate, or in bonds for that matter. But insurance companies solved this problem years ago with a product that literally guarantees you can't outlive your income. Instead of taking the risk yourself, you're shifting it to the insurance company. Here's how annuities work and why they might be the safety net for your guaranteed income base floor that you never knew that you needed. I'll be going through the 4 types of annuities with the specific data on when each makes financial sense and why current conditions represent one of the better annuity environments that we've seen in the last decade. And some real world application where we'll be going through exactly when annuities solve problems and when they create them with specific case studies and decision frameworks. And we'll follow and conclude by a complete action system, a step-by-step evaluation process you can use immediately. I'm Bob Wolf, certified financial planner and IRS enrolled agent. An important disclaimer before we go any further here, this content is strictly educational and should not be interpreted as specific investment, tax, or legal advice. So with that being said, let's jump right into it. So let's start by talking about what an annuity is. You are buying longevity insurance with a psychological bonus. Think about it this way. You're not just purchasing income streams, you're purchasing protection against some of the scariest financial risks that is the elephant in the room, outliving your money. It's not as much market crashes that destroy retirements as much as it is people living longer than their money lasts. Now we can go over what I like to call the foundation effect. When you have your guaranteed income covering your bare necessities, something magical happens to your investment psychology. You can actually be more aggressive with your other investments because you have that safety net of guaranteed income for life. This is why some of the retirees that have the most amount of peace when market winds are blowing have this not as their entire strategy, but as the bedrock that allows them to take calculated risks everywhere else. Now let's talk about the 4 types of annuities that are available. I'm going to teach you the expert evaluation framework for each type, including the specific data most people never see. Type number 1, income annuities. This is basically the pension replacement. These are the most powerful, but still somehow misunderstood. You hand over a lump sum and they start paying you either immediately for an immediate annuity or deferred, so some point in the future that your payment begins. A 65-year-old puts $100,000 into an income immediate annuity and gets $635 monthly for life. That's $7,620 a year. If she lives to age 90, she receives $190,500 in total. That's a 90.5% return on investments as of the time of writing this. In income annuities like this, for those who are also married, there are certain things that are called term certain and joint survivorship benefits that will help to insure even further against passing within a short period of time after purchasing annuity. Ultimately, though, that will decrease the amount of payments that would otherwise be paid to us on a very simple income annuity. The next type is something that's called the multi-year guaranteed annuities. This is kind of like that secret CD alternative. MYGAs are very similar to CDs in the sense that you lock up your money for a set period of time, albeit since there are insurance companies that are involved here, we are seeing some level of higher interest that is being paid from the insurance carriers rather than from the CDs. Each MYGA, each CD also has very nuanced term requirements where if you were to break the CD or the MYGA in a shorter period of time, there are interest penalties if you were to not stay for the long period. The third type of annuities are something called fixed index annuities. And when we talk about index and any annuities, they start to get increasingly complex. These let you participate in market gains with a floor on the losses. So for instance, if the S&P 500 goes up 20%, you might get 8 to 10% due to something called caps. But if the market drops 30%, you get 0%. So it's not negative, it's 0. The goal of these fixed indexed annuities is that they're not trying to beat the market. They're trying to give you a smoother ride and investment experience. The fourth type is the variable annuities. And this is when we should start to really understand what it is that we're getting into. And full disclosure, I rarely find scenarios where these types of products make sense anymore. The fees are typically running anywhere between 2 and 3% annually all in, which absolutely destroys your long-term returns. The expert piece here is really understanding exactly what you're paying for and whether or not there are cheaper alternatives that exist. Many of the times you can find guaranteed income in a cheaper venue that is not the variable venue though. Now let's talk about market timing and why interest rates change everything here. When I was looking to establish a guaranteed floor of income for individuals for their bare necessities when rates were at 2%, the payouts were terrible. Now, at the rates that we have right now, and in time of filming, this is 2025, we have much better payouts. As a result of interest rates having risen relative to where they have been, they're the best rates and payouts that we've seen in over a decade. And you're learning this at the perfect time. The reason this happened is because insurance companies invest your premium into bonds. And so when bonds pay more, they can pay you more. The same concept goes through for those who are considering pension payouts, whether it be for lifetime benefits or a lump sum rollover for any of us who still have that option, is the interest rate environment that we are electing at that time has a critical important factor in our decision making of whether or not it is a good level of payout or not. The same $100,000 that generated only $350 6 years ago now generates that $635. That's a massive increase just from interest rate changes. So what that means is if rates continue to rise, so too will the payouts of annuities. How do you actually value an annuity within your total financial picture? Let's say you have guaranteed income of $2,000 monthly from a pension or an annuity. What we'll want to do is calculate what that would cost to buy the same income stream today. So if it would cost you $400,000 to replicate that income, we need to treat that $400,000 as if it is a bond in your portfolio. This is something that gets a little bit more nuanced with how we approach the other areas of our financial life. So when I was working with somebody who had a $3,000 monthly pension, we talked about the replacement value being $600,000. And we realized that they could invest more of their 401k aggressively because all of his essential expenses were covered by guaranteed income, which meant all of the wants and all of the legacy pieces were something that could ultimately end up growing further over time because he didn't need the money every single year. Now let's talk about the tax optimization pieces of this. If we are to buy an annuity with pre-tax money, our 401k traditional or IRA that is traditional, everything you receive is taxable as ordinary income. If you were to invest with non-retirement funds, only the earnings portion is taxable. Each payment splits between tax-free return of principal and taxable earnings. This will be something that is sent to you in a tax form in the new year. So when do annuities actually make sense? To do this, we'll break down a couple of patterns that I've identified where annuities solve real problems. Number one, the sleep at night factor. An individual who has $800,000 saved but cannot stomach market volatility, we can opt to do $200,000 into a guaranteed income to cover the bare necessities so she sleeps fine at night and can invest the remaining $600,000 more aggressively. Psychology matters just as much, if not more, than the mathematics behind that. Scenario number two, the pension gap. High earning professionals with zero guaranteed retirement income. In those circumstances, we may end up opting for multi-year guaranteed annuities as part of the bond allocation because they currently pay more than traditional bonds without some of the risks that are involved in bonds, as long as we hold the MYGAs until the end of the maturity. The third instance that we'll look at is longevity insurance. Somebody wanted to ensure that their spouse would have a guaranteed income regardless of the market conditions or how long she lives. An income annuity solved this perfectly. We matched the tool for the specific problem and what it is that we're looking to solve. In the end, again, annuities are something where we are shifting the risk of longevity from ourselves being retained and investing to an insurance company. Now let's review when they are completely the wrong thing to do. The liquidity trap. If you might need access to your money, surrender charges can be absolutely brutal. I've seen 10% or more penalties in early years. Oftentimes, this drops a couple of years thereafter, but ultimately, the reason why there's surrender penalties is because a commission was paid to, oftentimes, an insurance broker to sell these, and the insurance company needs to recoup their costs on that. Next, the DIY investor. If you're comfortable managing risk and you have the knowledge, you can probably do better on your own. Lastly, if you have serious health issues, the longevity insurance aspect does not make sense. Now we can get to our decision-making framework for this. Before we move forward with any annuity purchases, I want us to ask a couple of questions. Number one, do I have a problem that annuity solves better than the alternatives? Number two, am I worried about outliving my money? If so, income annuities could be a solve for our bare necessities. Number three, do I want guaranteed income to cover the essentials? Number four, do I want maximum growth potential? If so, they probably can't solve this. If you're looking to move forward with an annuity, here's what I would recommend. Only consider A-rated insurance companies. Number two, understand every fee and surrender charge. It's a contract and it's a lot of pages to read, but you need to know what you're signing. Number three, know how it integrates with your other income sources and resources. Number four, get an independent analysis from a fiduciary advisor who is not getting paid for you buying this product. And number five, evaluate the current interest rate environment for timing because that can have an incredibly large impact on the payouts. So how do we go about implementing this? Number one, calculate your essential expense coverage needs. Number two, evaluate your risk tolerance for your remaining assets. Number three, compare the current annuity rates to historical data. Number four, model different scenarios with your specific numbers. Number five, consider tax implications for your bracket. Number six, plan integration with your existing retirement income. Now you have a systematic understanding of annuities that most financial professionals lack. Thanks for watching, and I'll see you in the next video where we'll tackle another financial topic that's probably more complicated than it needs to be.